All right. Thank you everyone for joining. Thank you, Vish. Thank you, Gary. The discussion for today is probably one of the most exciting consumer growth stories out there. We're going to be talking about the QSR industry, the quick service restaurant industry. And I think it's an interesting discussion because if you look back, I think the largest private equity wins came from QSR. I was reading about it, whether it's Bain Capital taking the Domino's private in the late 90s, or whether it was TPG, interestingly, Vish, who were the initial backers of Burger King, and then I believe Bill Ackman also came in and drove that aggressive franchise growth. And then you have Roar Capital, who's sort of become the recent QSR consolidator, taking in Arby's, Dunkin, Jimmy John's, and I think the
Subway
playbook
as well.
was Subway as well, a big one actually. And I think the idea was very clear, and I think the discussion will sort of revolve around it today as well. I mean, the idea was to back scalable QSR concepts, drive that operational discipline, something we spoke about before, and I guess the goal is to eventually unlock that investor return. And now the US is in a very strong point when it comes to QSR. I mean, they've created billions of dollars in value, and I think India is nascent, and we're in that similar inflection point. Um, and I think given our macros, our rising disposable income, the rapid urbanization, and I think we have a young population that loves that affordable convenience that we did not have access to before. And I think that makes QSR one of the fastest growing industries in the country. And I think it's helpful and it's very timely that we have both Vish and Gary with us. And I think Vish, it'll be helpful, if I would love to give you a background, but I feel that um, you would be best to give it, with your experience when building Ambrosia Foods and into this multi-brand QSR platform. And Gary, of course, bringing that institutional investor lens, and why the QSR sector is right for an institutional investor, and why Ambrosia may specifically, fit into that broader portfolio view. So I think we can just dive right in. Vish, I'll let you take over.
Great. Thank you, Nirvan. I think you summed it up really well. Let me start with a quick introduction. So, my name is Vish Narain. I'm the executive chairman of Ambrosia Foods. And we are also run a fund called Pulsar Capital, which has a slightly different model from usual PE firms, where we buy and run assets, very much like, say, a 3G Capital, where we acquire assets and then we grow them over a period of time. Our model is that we 10x the investments that we do. So we do very selective deals, only one deal a year. But the ones we do tend to be very center of plate, with sectors that are large, that have the potential of building large companies. We typically do deals of businesses which are mature, but in the sort of $100 million zip code enterprise value, and then we try and create billion-dollar businesses. Now, prior to Pulsar Capital, I was a partner and country head for a fund called TPG Growth, where I was there for 12 years. We led many investments, particularly in consumer and tech. So companies like Lenskart, Nykaa. We invested in dairy business called Dogla Dairy, Campus Shoes, which is like the Nike or Reebok of India, a company called Healthium, which is in the medical device space, Motherhood Hospitals, one of the largest mother and child IVF businesses, Masan Foods, which is one of the largest FMCG companies in Vietnam. So have a ton of experience in consumer and tech. Several of these businesses were 5 to 10xers, if not more. Lenskart, we were very early, came in at $100 million valuation. The company is now going public at a $10 billion valuation. So it's been a more than 40x growth. So it's been successful ride. It's been an exciting run. And I think the QSR space now, as Nirvan said, is at that inflection point where I think we can have a 10x outcome from here on. Prior to TPG, I was a partner at McKinsey and Company. and did my undergrad from IIT Delhi and my MBA from Stanford University, where I also serve on the board now. So coming back to QSR, globally, as Nirvan said, a lot of money has been made, whether it's Warren Buffett investing in, of course, McDonald's for many, many, many years, Dairy Queen, Domino's, and Yum brands, Yum China, Philippines has Jollibee, Thailand has Minor Group. So pretty much every economy which has gone from $3,000 per capita to $10,000 per capita has created local champions in the QSR space. And India has, over the last 10, 15 years, has had a few successes, Jubilant, for example, but not to the scale that will come about now over the next 10 years. And there are three reasons for that. Reason number one is that our affordability was much lower 10 years ago. So 10 years ago, the average order value was only about $3. Now the average order value for Domino's, Burger King, Pizza Hut, etc., is about $7 to $8 versus a global average of about $11 to $12. So we are halfway there in terms of getting up to global standards. So that's one change that has happened, and it will only continue to grow as India gets more affluent. The second change, which is a positive change, is that post-COVID, the percentage of delivery has gone from single digits to almost 50%. So Burger King, for example, had in 2019, 2020, 6% delivery. Now it is 46% delivery. Right? So the delivery percentage has gone up. And as a result, the rent, which is a very large percentage of the cost base in India, which was earlier 20%, has now come down to single digits because you're sweating the kitchen much more because half the assets are now delivery. So the listed players now are at 7, 8, 9% rentals. And as a result, the EBITDA margins have gone up. So EBITDA margins of listed players are all in the kind of 14 to 20%, which is in line with global standards. So the unit economics have also improved. So point number one, AOV has increased. Point number two, EBITDA margins and unit economics have improved. And point number three is that the attractiveness of QSR is that it can give you scale. So unlike casual dining restaurants or sort of premium restaurants where you can have only a handful, you can get serious scale in QSR. So there are 35,000 Subways in the US, 40,000 Starbucks, 20 odd thousand Burger King. So that kind of scale is only possible in QSR. And that scale is now coming about in India, where earlier it used to be only an 8 metro market, which grew to a 40 town market. Now there are Domino's, for example, sells in 418 towns across the country. So we will see now, that the scale of these companies in India will go up substantially. Like the number of Starbucks in India is only about 400. The second largest chain, Blue Tokai, has 170. Right, that number will be more than 10x in the next decade. Same thing for Subway. We have 800 Subways. That number can be, 8,000. US has 35,000, and we are 3 times the population, maybe more than 3 times the population. So I think the scale, the unit economics have all corrected in the right direction. And I think that's why it's an inflection point where it's time to build really large companies. The final data point I'll share is that if you look at the listed market cap of the QSR space in the US, it's $480 billion. In India, that number is 15 billion with only 5 listed companies. Right? And if you look at the aggregator market cap, in India, Swiggy and Zomato market cap is about 50 billion. In the US, the Uber Eats and DoorDash market cap is 60 billion. Right? So if the aggregator market cap over time will grow, but the listed market cap of the supply of the restaurants in India will grow from 15 billion to 100 billion. Right? And that's a piece of that is what we want to take. And we want to build a $1 billion business to start with and then grow from there. Now, so we are excited about QSR. Now, what in QSR? Right? So the largest category in QSR is biryani. It's the most ordered cuisine in Swiggy and Zomato for the last 5 years, continuously. And we are looking to acquire a controlling stake in the largest biryani chain in the country. It's a South Indian brand called Nandana Palace. has been around for 30 plus years, has about 60 stores, does 450 crores of revenue, about 80 crores of EBITDA, or $55 million of revenue, and about $9 million of EBITDA. And we're getting a opportunity to acquire this at a 11, 12 times EBITDA multiple, which is much lower than comps, which are in the 25 to 30 times EBITDA level, the listed comps. In addition, we also have the third largest global pizza chain called Papa John's, where we've got the master franchise at very attractive terms with 3% royalty and no per store fee, with relative to, say, Domino's or Pizza Hut, it's half of what they pay. So it's a very attractive deal that we got. And we are in the process of setting up 600 odd restaurants over the next decade. So pizza and biryani are number one and number two cuisines. So we picked the largest segments. We picked the market leader in biryani. We picked the number 3 global brand. So we think we picked the right assets to start the platform with. And once these two deals are done, we will be open to adding one or two other categories like coffee or like desserts, which are also attractive in terms of unit economics and paybacks. So that's the quick summary of the opportunity. I believe, we are buying this at a very good valuation. It's a $100 million valuation. And, over the next 5 to 6 years, we can make this a listed business with more than $1 billion market cap. So that's the quick summary, Nirvan and Gary. Let me pause there and see if you'd like to deep dive on any of the areas I spoke about, or if you have any other questions.
No, lovely. I think that was a very helpful intro, Vish. Just while you were giving the intro, I had a quick question, because I think this is something, that a lot of people, I guess, in the space really focus on. And what is the sort of difference between, pushing one hero brand versus being that consolidator and adding a multi-platform brand, such as, a Papa John's and Andana, and, a future coffee chain, etc.
Yeah, so look, I think the successful models that we have seen, whether it's 3G, Capital owning Restaurant Brand International, their philosophy has been that if you have a portfolio of brands, that tends to perform better than having a single brand. Whether it's Yum brands, such as KFC, Taco Bell, Pizza Hut, or whether it's 3G, RBI has Burger King, Popeye, Firehouse Subs, and Tim Hortons. And Inspire brands owned by Roark has 10, 12 brands in the portfolio. The choice of having multiple brands has a lot of synergies. The synergies comes across 3 levels. Number one is aggregator commissions. In India, you pay 20 to 25% aggregator commissions. If you have a platform with multiple brands, you can pay sort of 13, 14, 15%. Right? So there's a 500 basis points synergy right there. In addition, there are a lot of shared functions like finance, HR, the delivery fleet. There's a lot of optimization. Coffee is a morning business. Biryani is an evening business. Nobody eats biryani for lunch or in the morning, right? Everyone drinks coffee in the morning. So there is a synergy there. There is synergy across the teams that build the stores, across negotiating the rental agreements. If you're negotiating for 50 restaurants versus 200 restaurants, there's much more scale and synergy. So there is significant synergy doing this as a platform. And of course, there's a scale synergy, right? So from a listing perspective, if that target is to get to 100 crores of net income, or about $12 million of net income for to be a successful IPO, that scale can be achieved much quicker if you have multiple brands versus a single brand. So there's enough data points globally to show that having a portfolio is better for scale, is better for synergy. And also, the way we are picking the brands is that we are picking successful brands that have already done well, either in India or globally. So this is not a venture model where, like some other companies like Rebel Foods, where they incubated 30 brands. Now they've turned out that only 4 or 5 are scaling up. That's not our approach. We are buying companies that are already successful in India, which have substantial revenue or EBITDA, or global brands that have proven themselves, like Papa John's has in 51 markets around the world, 6,000 stores. So this is not a new brand. And the same thing we would do for one or two other categories that we look at, that we will either pick a winner or we will pick something which has the product market fit is already proven, that we are not taking venture risk on any of the brands that we invest in.
That's super helpful, especially the the terms with aggregators. I feel is a key component, and I think that brings me on to my next thought, which was the unit economics. And if you could provide some, insight into that and the expansion plans, and I believe, sort of balancing that expansion with maintaining unit economics, because I think that is sort of one of the key questions when it comes to operational abilities.
Sure, sure. So let me start with the biryani brand. The biryani brand does about 62% gross margin. So the food cost is about 38% and does about 27% store EBITDA, and then about 17% corporate EBITDA. So it's a healthy business. Just for context, the largest player in India, Jubilant or Domino's, has 19% EBITDA margin. So they are in the sort of top decile, so to speak, in terms of food brands. In terms of return on capital employed, right? So a typical store costs something like $350,000, $300,000, and the store does roughly store level EBITDA of about $150,000. So you're getting a payback in 2 years or less, which is a very attractive payback. In a restaurant business, if you're getting sub 2 year payback, it means a ROIC of 35-40%, which is where you want to be. So that's on Nandana. On the pizza side, it's very similar. So the store capex is lower. You spend only about $150,000 per store, but you do about 250-300,000 of revenue with a similar 25% store EBITDA. So the payback is slightly higher, 2.5 years, but it's that zip code of that 2.5 year is where you want to be. So attractive unit economics. And in terms of the scalability, the plan is to grow Nandana from 60 restaurants to 130 restaurants over the next 5 years. So it's not a crazy growth plan. Doubling over 5 years in India is par for the course. There are many brands that have done that. For Papa John's, we plan to set up about 250 restaurants over the next 5 years. About 30% of them will be cloud kitchens. Another 40% will be what are called delcos, which are called delivery and carry out outlets. These are small outlets with 20 seaters, 4-5 tables, similar to what a Domino's outlet looks like. 10% will be dine-ins, which will be the 60-70 seater. There'll be the flagship stores, and when you enter a new city, you want to put 1 or 2 dine-ins, and the rest will be highway outlets or mall outlets. So that's how we plan to do it. We already have a partnership with the largest cloud kitchen provider in India called Rebel Foods, where they already have 400. So we will be able to place close to 70-80 kitchens with them almost immediately, right? Whenever we think is the appropriate time, because they have the space available for us to expand. So the remaining stores, we have a great team to build out, and we'll be building out, roughly 30-35 stores a year, which is not that difficult to do. Domino's, for example, does more than 150 stores a year, so it'll be like a 1/3 or even less than that, 1/4 of what they do. So I think it's a good mix of growth, but also measured capex, so that we are not eroding the strong profitability that we already have on the biryani side.
Lovely. No, that's super helpful. And how do you compare the unit economics of Ambrosia in India with global benchmarks, given the fact that we effectively want to scale to that level and that size, in terms of margins, in terms of scalability, and also you mentioned scalability in sort of different regions within India. what's the sensitivity you take when you expand, let's say, from a Chennai to a Hyderabad or like a new city and a new state? What sort of levels do you use?
Sure, sure. So I think we are reached global benchmarks, Nirvan. I think if you see the EBITDA margin, we are in the global companies are in that 15 to 20%. Some of them have higher EBITDAs because they franchise a lot, right? So if you franchise a lot, you're effectively getting a very high EBITDA margin royalty. Today, in India, nobody has been successful franchising. So we will be building the stores and running the stores ourselves. And until India is ready from a quality perspective and quality of franchisee perspective, I think for the next 5 years, I think the industry will remain company owned, company operated, which is what all the guys are doing, whether it's Domino's or Pizza Hut or KFC or Subway. In fact, Subway was the only one that tried to franchise. They failed. And now the master franchise is buying back all the sub franchisees. So the people have tried, and I think people have realized that getting a lot of franchise in India takes shortcuts. Right? They don't put the right quality vegetables, the ingredients. So the brands are extremely sensitive to making sure that there is a certain consistency and quality in terms of the sourcing, in terms of the store ops, in terms of the cleanliness. So all of those factors have led to the fact that stores in India, 90% of the brands are running company-owned, company-operated stores. So that's what we plan to do. In terms of geographic expansion, we'll do it in a cluster manner. So Bangalore is where we are starting. We want to get to 20 stores of Papa John's there. We already have about 25 stores of Nandana. And then we'll go to Chennai, then we'll go to Hyderabad. So we'll do south, then we move to the west and then to the north. So we'll do it in a very considered fashion, in a clustered way. A lot of people have made the mistake of going to 40 cities immediately. That increases the corporate costs, increases the capex because you have to have central kitchens in all the cities. So the right way to do it is to do it in a cluster. And India has a lot of scale now. So Bangalore itself has 160 Domino's. They have 92 Pizza Huts. We are planning 40 Papa John's. The National Capital Territory of Delhi has 260 Domino's. So our towns are now very large. And I think you can have significant scale just looking at Bangalore, Chennai, Hyderabad, and get to 100 stores before move to Mumbai, Pune, Delhi, Chandigarh, etc. But we want to do this in a measured and considered fashion, in a clustered way, rather than spraying and praying and setting up stores across 20, 30 cities right away.
Great. And could you give us insight into who would be leading the brands on the ground for both Nandana and Papa John's and their background?
So for Nandana, the promoter family has been running it. Dr. Ravi, who's the founder, and his two daughters, Shweta and Ramya, they've done a great job running it. So they will continue to run the company. We will, of course, professionalize it. We've found a chief operating officer who will be joining us shortly. We'll also be augmenting finance, marketing, so some level 2 employees. For Papa John's, we have a crack team. The CEO who's running it has successfully run Papa John's in the Middle East, in UAE, Saudi. He's an Indian gentleman with a ton of experience in QSR. He's been franchisee of the year for the last 5 years in a row. And it's UAE is one of the few markets in the world where Papa John's beats Domino's. So Domino's has 65 stores in UAE. Papa John's has close to 100. So they are almost 1.5 times the size. And Tapan, who is the CEO, has the playbook. Right? So we've done this well. As you know, roughly half of UAE is Indians or Southeast Asians from Pakistan, Bangladesh, and India. So the recipes, the menu, the product market fit is already proven in many ways in UAE because half the market is population which is from the subcontinent. And Tapan has successfully led that. The chief operating officer is the ex-head of South India for Pizza Hut. He was managing 200 restaurants for Pizza Hut in South. So he comes with 5-6 years of strong pizza pedigree. And prior to that, he set up more than 500 cafe coffee days. So he's got the 20-year track record. So the rest of the team comes from Domino's, Haldiram, McDonald's. So good QSR pedigree. So very excited about both the teams. I think we have the right people for Papa John's, which is sort of a new build, but ensuring continuity with the same team in Nandana, but complementing the team with some sort of professionals at the CEO -1 level.
Great. And more specifically, with respect to the terms of the deal, if you could give us some insight into that, and also the sort of road to what the end game vision will be, whether the idea is to go for an IPO or whether, to become that Roar Capital India consolidator, and how sort of you'll require capital to continue your expansion plans over the next 5 years.
So we're raising $50 million right now for this round, with a valuation, post-money valuation of about $100 million. The platform will do this year EBITDA of about $9 million. So it's about 11 to 12 times EBITDA, which is attractively priced relative to comps. We don't need much capital as a platform moving forward for these two brands, because Nandana itself, is generating cash flow, and we might be able to take some more debt to fund the Papa John's expansion beyond the first 20 stores. And if we do look at another brand, at that point, we will, of course, might need more capital, but that is to be seen at that point, and depending on the terms of that deal. But these two brands itself, over the next 5 years, will get us to a revenue of 2,000 crores with an EBITDA of more than 250 crores, which will get us a market cap in excess of 5,000 crores, which is a 6 to 7x from where we are today. So we do plan to list within a 3-year window. I think we should be big enough within 3 years to list. And then, of course, the sky is the limit. I think if we have opportunity to keep compounding, we should remain a strong, profitable listed player and become one of the top 5 QSR brands or QSR platforms in the country, and hopefully add 1 or 2 other assets in the categories I mentioned, like coffee or desserts, which are attractive categories from a return on capital perspective.
No, lovely. And Gary, I wanted to pick on you and understand from you what makes QSR a compelling sector, and why, from Sapiens side, how does Ambrosia and how does sort of the QSR sector fit in your broader portfolio base?
Yeah, thank you, Nirvan. And what a great story we've been listening to and been immersed in over recent weeks. When I think particularly, obviously, as a foreigner and people looking from the outside in, it's always been difficult to buy a true reflection of Indian GDP. It has been a relatively narrow market. It's a relatively small market in a global context. And people want to ride on the coattails of growth, on concepts that they understand, and where there's just a kind of clear story. And I think this is where the QSR, and I would say broad, the consumer story fits. You can see the aspirations of an enormous Indian population. You can see the growth. You can see the growth of incomes. How are they going to spend it? How do I get a bit of that action where the average Indian household is upgrading their lives in different manners? And I think QSR, people have an affinity with food. They understand food, and a lot of foreigners think they know a lot about Indian food. But that you can, I think, very transparently see the story. You can see the growth. And the numbers that Vish has quoted, I'm still gobsmacked in a sense, even knowing India well, at how small this sector is in the grander scheme of things, of just the concept of eating out. And as you both know, with an Indian family, even if I go back to the early days of my immersion of that Indian family, it was eat at home, and then it was Domino's, and then it was a bit of KFC, and you could see this enormous opportunity in the market. So I think, what they will be looking for is a company that looks international. It has the quality of management. It's keeping things relatively simple. Again, one of the mistakes often made in emerging countries is people being too ambitious. I want to be the biggest. I want to have 1,000 stores. These complete mistakes. So I think there are many great things about the whole concept of the QSR. And at this point in time, there are just so few opportunities to get materially involved in this concept and to get engaged in something that's going to grow as quickly as Vish's company.
No, absolutely. I fully agree. And with respect to the different sort of industries within India, I mean, what makes consumer QSR specifically the most excited for you as compared to, the IT industry, the tech industry, or the sort of industrials? Because India is vast. So, in terms of what is your thought process behind QSR?
Well, I think there's room for everything, quite frankly. But I think when you look at the capex cycle, if you go to say what are the big things happening in India today, I would say on the capex cycle, it is very difficult to get a grip and a hold in one particular company. Obviously, with industrial companies, it gets diluted down because those companies have many facets of business that they're in, often in a conglomerate status. And if you're talking about tech, companies in India will not kind of wash it when people are trying to find the best growth story in the tech industry. That clearly that capital tends to migrate straight to the United States. It's not something that people would necessarily come to India for, although India still offers some good opportunity. But I say in that consumer sector, if I look at consumer spending growth in the United States, it might be 1.5%. If I look to some of the other markets, I might be talking about 2% or 3%. And here I have a massive step up into a market which is clearly going to grow, has got very clear reasons why it's going to grow. And I'm not dependent upon, in a sense, GDP growth to achieve some of the milestones that Vish has talked about in terms of growth within this business. This is about a new proposition in a place where there's clear demand, as opposed to trying to create the demand. So I think this is why it all comes together very neatly for a QSR concept.
Absolutely. And
Nirvana, I'll just add one more point to what Gary just mentioned. I think we're all a cricket crazy country, right? And there's a format of cricket called 2020, right? Which is the most popular format. And I think the QSR industry is also a 2020 format in the sense that this sector companies can grow at 20% growth rate with a 20% ROIC, right? And it's very few sectors have that characteristics. And I've evaluated more than 3,000 companies. Industrial companies tend to have low ROICs, have often volatility in terms of demand and supply. Cement businesses go up and down. You'll have, renewable sectors where there'll be periods of high growth, but then you'll have excess demand. This is a very predictable, 20% consistent growth where with excess of 20% ROIC. So it's a sector which is often very attractive for public market investors because you can see predictable growth with high degree of capital efficiency. And there are not too many sectors which offer that. And especially if you can buy into this at an attractive valuation that we've got, I think it's pretty compelling opportunity.
No, absolutely. And with respect to 2020, I'm from Generation Z, so I can definitely vouch for the fact that our generation likes speed and convenience, and we have low attention spans. So, on a general basis, I feel that as the youth of India is growing and they're finally, making a lot more money than they were before, that convenience factor is really going to boil down, and it's going to create a huge cultural transformation of India and India's youth and how we not only experience life, but how we grow, we eat food. And I think that's highly underpenetrated now, which is one of the most interesting and exciting parts about the QSR industry right now. Also, I think it's also important to always go discuss this as well with respect to risks and risks attached to operational issues and because you, Vish, have seen so many companies succeed and grow under your belt at TPG. And of course, a few have also, as they don't ever succeed as much as they were supposed to. So, from your perspective, what have you learned and what have you seen and witnessed that what makes companies tick and what makes companies fail, and what are the specific risks that you think could be attached to Ambrosia?
So in this particular segment, Nirvan, it's a very operationally intense business because today Nandana has 2,000 employees across their 55 locations. So you have to have, train these people. These are relatively lowly paid employees. They make, $500, $300, $400 a month, right? So even though there is a lot of aspiration and there's a lot of young youth coming into the workforce, but it's not an easy task to recruit, train. There's a high degree of attrition that occurs. So getting just the human capital aspect of making sure that you have high quality labor force, which stays with you for a period of time, I think it's the biggest challenge. I won't call it a risk, but I think it's something that we constantly have to work on. I think the Domino's people have done a great job at it. They have 15,000 delivery boys. They have a workforce of more than 20,000 store staff. And as India is growing, there is a tussle for every segment. There is Zepto came in with quick commerce. They are hiring away delivery people from Domino's and from Swiggy and Zomato. So with growth, human capital and trained human capital is the biggest, I would say, constraint or biggest enabler and differentiator. Right? And I think that's where we will be spending a lot of our time to create systems, processes, incentives so that we can retain and hire the best talent, especially at the sort of entry level, which is where the maximum attrition takes place. That's one risk. I think the second is just growth, as Gary mentioned, doing growth in a measured fashion, right? And I think not to get carried away, set a realistic goal of 8 to 10 Nandana stores a year, which is what we planned. 25, 30 Papa John's to start with, which is again something which is very realistic. So do things in a measured fashion and not get overexcited with super paced growth, because that culturally also is difficult to manage when you have too many people joining at the same time, and things tend to crack when you have too many balls in the air. So I think measured growth and then focus on training operations, I think, is the two main areas that we'll be focusing on.
That's fantastic. That's all from my side, Gary. If there's anything else you want to bring up, happy to go over that. Sorry, you're muted, Gary.
What strikes me about this opportunity for investors is the quality of management that's been brought to bear on the business, and its capital light structure. And I think those are there in a lot of Indian companies in certain percentages, but I think this is a great mix to take this concept forward and to provide a kind of, I would almost say, a de-risked opportunity in a great growth sector.
Oh, lovely. Thank you, Gary. Thank you, Vish. I think that's super helpful. Really gives us interesting insight, and I'm glad we're using this medium. I think it's just easier to capture everyone's sort of thoughts and processes over a long document. So glad you could join us, and looking forward to seeing you when you're back in Dubai.
Wonderful. Thank you, Gary. Thank you, Nirvan. Appreciate it.
Thank you, Vish. Thanks, Gary. Chat soon.
Thanks. Cheers, bye.